Welcome to the concluding episode of Sustainability Talks here on Business Tech with RMB. And over the course of the series, we've really spoken about a lot. We've spoken about transition finance and the hard trade-offs facing carbon-intensive economies. We've unpacked carbon markets. We've explored social and development finance and all of the innovation that really drives and underpins this. But there's one part of the climate conversation that ties much of all of this together, and that's called adaptation. Because while mitigation is about preventing future damage, adaptation is about dealing with damage that is already happening. And nowhere is that tension more acute than here in Africa. We see climate losses are rising, insurance claims are rising, infrastructure is under huge pressure. Just look at the recent Limpopo floods. And we see communities highly exposed, and increasingly balance sheets are feeling that pressure as well. So today we're asking, I think, a slightly more harder, more pragmatic question. How do we finance resilience as a credible, investable financial strategy? And what role do insurers who really sit at the intersection here of climate risk play in making adaptation finance real? So to unpack that, it's a great pleasure to have Abel Sakur, who's Chief Sustainability Officer at Sanlam, in studio with us. Abel, thanks so much for joining us. And Nigel Beck, who is Head of Sustainable Finance and ESG at RMB, in studio. Nigel, maybe you could just kick us off. I think adaptation finance is probably most critical for South Africa in particular, Africa more generally, because we, if you look at all the climate models, are set to really bear the brunt in an outsized manner if we miss our 1.5, 2 degree target. So what do we mean when we talk about adaptation finance?
So I think, first of all, mitigation finance is the reduction of greenhouse gas emissions. Adaptation finance is how do we adapt to the change in the physical construct around kind of climate change. So, first of all, for example, if you look at resilience is how does human society, natural systems adapt to the shocks of climate change. Adaptation is how does society evolve or adjust to the changes in kind of physical climate change, kind of as you mentioned. Obviously, within emerging markets, there's a greater risk. I think our infrastructure is much more vulnerable. People are much more vulnerable. So the actual impacts of climate change and specifically importance of adaptation is increasingly important.
And as I said in my introduction, we really have seen how vulnerable communities in Limpopo, for example, are to a flood event that previous models were unable to predict. So, Abel, from where you're sitting, as an insurer, I'm sure you're very interested in this because it impacts how you underwrite for risk, how you price, how you design your products. How are you thinking about adaptation finance in the South African context at the moment? Well, what are the big challenges for you when it comes to ensuring that we're prepared for a world where these kinds of floods become more common, droughts become more common, fires become more prevalent? It's very difficult.
Absolutely. It's very difficult and complicated also to underwrite because, where we operate in a space where we underwrite some of municipal infrastructure, you also have individuals in terms of property. And adaptation finance and, underwriting and insurance is not something that, individuals and municipalities will understand what is it that we mean, because we're trying to underwrite a risk that might happen in future without stipulating what type of damage is going to happen. Because we know with climate change, in your introduction, you mentioned, for example, that, we might likely go over 1.5 degree or 2. The other statistics that you see is that we already passed that, And now what we have then to deal with is that how then do we try to understand what are the likely consequences of the current climatic vulnerability that globally we're experiencing. And the case in Limpopo, and Mozambique, could we have predicted that? As an insurer, then you ask yourself, would I have had models to be able to underwrite that and predict it the way in terms of the extent? Because it's not just on the basis that we know we're going to have frequent floods, but it's the extent on infrastructure damage, And also The challenge that we also have is that we've got infrastructure that is not built for what we're currently experiencing. How then do you make sure that when you underwrite and you transfer that risk to the owner of that infrastructure, they understand exactly what is it that their responsibility is? If you've got a bridge that was built in the 60s, whereas today you need to redesign that engineering of that particular bridge so that it can survive the floods that we are currently experiencing. So you're trying to fix the infrastructure that is historical to survive the potential weather phenomena that we're going to have in future. So there is now that gap, even from an underwriting perspective and from understanding the risk perspective, to say, does this infrastructure going to cope with what the climate models are predicting? So that's where the challenge we have. And education for us is also very important, to say, how then do you start educating the insurance owner to say, this is what we mean. If you are a household, you have to make sure when you build a perimeter wall, it must be at a certain specific design. You must make sure that if they live where there is a high risk of fire, how they should maintain their property, because those becomes conditions as part of their insurance. Because if they don't maintain as per the conditions, that means any claim can then be repudiated.
And as someone who recently bought a thatch roof property, it's becoming increasingly harder to get insurance for that kind of property. Not uninsurable, but the forms are certainly getting longer because the risks are increasing. Nigel, from where you sit at RMB, what does this then mean for how you approach and your funding priorities in the adaptation?
So I think, it's fairly broad. So I think, first of all, if you look at money spent on adaptation resilience, is money well spent. So if you spend, for example, the $1 on adaptation resilience, the benefits seem to be $2 to $10. In other words, $2 to $10 in kind of almost risk mitigation. And risk mitigation comes in various different formats, kind of like Abel was alluding to. So, for example, if you were to put in drainage infrastructure in a road network. So I don't know if you've been to Nairobi at all, but if you in Nairobi at all, when it rains, the roads totally flood and there's total gridlock all the time. So, for example, if you put drainage infrastructure in a road network, or if you put a water reservoir into drought-stricken area, these are ways to kind of mitigate some of these risks. I think directionally, what we have found is that the impacts, the physical impacts, are becoming more and more prevalent. So 122 countries have issued their NDCs, or nationally determined contributions, which amount to 80% of global emissions. Now, essentially, what we found is that it looks like the world is on a course of 2.3 to 2.5 degrees temperature rise. That's above the 2 degrees we're trying to target, or definitely above the 1.5, which we're ideally trying to target. And what that means is it's starting to manifest itself in this kind of physical risk that we're talking about. So physical risk comes in two forms. It comes in kind of an acute or event-based like risk, where floods, fires, etc., or kind of more of a systemic risk. The World Economic Forum has actually quantified over the last 20 years the impacts of climate change from a physical perspective on global societies, about $2.8 trillion. So it's having a significant financial impact. And within the financial sector, what we're looking at is I guess, through two lenses. We're looking from a risk perspective. So first of all, non-performing loans.
Yeah.
So, I think there were a number of floods in Latin America a few years ago. And I think the increase in non-performing loans in the Latin American banks was about 1.4%. So it increased non-performing loans, operation expenses, impacts on your physical infrastructure, and then also trying to quantify data, trying to get climate data, specifically physical climate data, to try and understand the risks in your portfolios becoming more and more prevalent. So there's a need to have quality, quantifiable climate data from a physical perspective to try and understand your risk. And then obviously there are products that we're starting to look at, and we can delve into those a little bit later if you want to. They very much talk to kind of the adaptation and resilience of climate finance.
And because I often look at these event-driven risks, for example, that we've just experienced, in Kruger National Park, around Limpopo, in Mozambique, is going to be a rebuild now. And surely within that rebuild, one needs to be incorporating adaptation engineering principles. Say, right, when we rebuild, now there is an opportunity to rebuild infrastructure that can withstand more intense, more frequent flooding, that kind of thing. Insurers deal with risk as your bread and butter. I mean, that really able is the business that you're in. So how do you think about adaptation, not just as protection, but as a form of long-term risk prevention that really stabilizes these insurance pools? Because insurance is all about, transferring risk from large pools of insured.
Yeah, definitely. I think for us, we don't see this as something that we can do from a short-term perspective. Yeah, it's long-term. We've accepted that, the realities of climate change are here. When we do a risk assessment on a particular asset, we then have to understand what does that really mean, in different scenarios. And, we've just finalized our climate scenario analysis for that particular reason, because you really need science to actually help you to then understand what is it that you're dealing with. So there's that technical work that we do to say, when we look at assets, we look at them from a climate perspective lens, including from your traditional, actual science. But there's also that element of human behavior and also infrastructure maintenance that we sometimes don't talk about when we look at issues of adaptation. If you've got an infrastructure and it's not maintained, it doesn't matter the level of insurance and risk protection cover you're going to have. That infrastructure is likely going to fail, because if you are not maintaining your stormwater drainage. So we then have a two-pronged approach to say, while we do the technical underwriting aspect, you also have to work with municipalities, because that's where, when system fails, it starts affecting households, start affecting individuals. Working with municipalities is to say, it's important to maintain infrastructure. We intervene there at that level of the easiest things, stormwater management system. Do you clean your stormwater? The road network. Do you collect waste? And you need that dual approach, because otherwise you're going to see risk premiums going up, because you're not going to be able to mitigate some of those risks in terms of any insurance covered, because the infrastructure is not maintained. So there's that level of education, because people don't understand the climate science like we do. We deal with it, on a daily basis. And we then need to also invest in terms of how then do we make sure that, instead of just focusing on how do we transfer risk or we protect ourselves, how do we also move society to understand what is happening?
Yeah.
Because that's very important.
Now, I was reading an article from Gunther Tallinger, the CEO of Munich Re, one of the largest global reinsurers, ahead of this World Economic Forum, and raising the alarm about certain regions in the world potentially becoming uninsurable. You look at what's happening in Florida, the frequency of hurricane events, and the reinsurers just can't take on that risk anymore. And you just think about the economic consequences of being unable to get mortgage insurance, impacts of property market, wealth creation. Fortunately, we're not in that situation in South Africa. But Nigel, I want to come back to how you then think about this at the bank in terms of, what you're looking to fund and the kind of catalytic role that you can play in helping South Africa with its adaptation goals.
So I think, first of all, if you look at kind of the market, so coming out of COP30 recently, and COP30 was coined kind of the adaptation COP, there was a need, and there was I think a target that was set there to increase adaptation finance threefold by 2035. At the moment, adaptation finance is about 5% of global climate finance. So it's a very, very small portion of global climate finance, and about 90% of that 5% come from public sector. So the idea is we actually need to start shifting this narrative away from the public sector, more towards the private sector. And I think there's a few reasons for that. First of all, in certain instances, there's a lack of awareness. There's a lack of awareness trying to understand exactly what adaptation finance is. I think sometimes it's quite difficult because the physical risk and adaptation manifest themselves over a period of time, and they're not instantaneous. it happens over a period of time. And second of all, from a business perspective, it's quite difficult to understand the underlying cash flows as different to repay a loan, from a flood event. So, that's left kind of adaptation finance a little bit behind mitigation finance. But I think the idea is now we need to focus on that a bit more aggressively, which is why these targets are coming out of COP. And I think there's going to be increasing need for us to look at specific financial instruments that are going to drive this forward. So if I think of instruments that I think are going to play a key role in this going forward, for example, blended finance, I think is going to play a particularly key. How do you blend in private capital, public capital, DFI money, each with different risk return appetites, to make sure you can take a project that might traditionally be seen as some type of public good, and make it essentially investable. And how can you get broad scale investment into these type of instruments? So we definitely see a greater focus on that. Natural capital, I think we see a lot of focus on kind of natural capital financing, conservation, ecosystem services. How do you direct private capital towards kind of conservation? For example, removal of alien vegetation to make sure that you get kind of effective water flowing to water catchments, revegetation, and the like. And then I think the final one would be debt for adaptation swaps. So essentially where you take distressed sovereign debt, you look at kind of the differential in the coupon and use some of that to focus on adaptation. So it's very similar to debt for development swaps, but very much more nuanced around kind of adaptation. I think these are the type of instruments we're going to start building out over the next 5 years, and going to particularly, I guess, move this adaptation finance opportunity forward.
That's really interesting to see how the space is developing and the innovation. But to your earlier point, as you say, for every $1 invested, the returns being between $2 and $10, it absolutely makes economic sense to do it. From an insurance perspective, Abel, what role do you see the insurance industry playing in helping drive this conversation forward, given that you said you do underwrite a lot of local government, obviously the private sector as well? You do seem uniquely positioned to play a catalytic role in bridging the public and private when it comes to building out maybe blended finance or public-private partnerships in response.
Yeah, and maybe also just from what Nigel also said, also to say, when we talk about, adaptation finance, also we should not, assume that it's all about just physical risks. There's that element where, it's not about the flood, but it's about crop failure, because temperatures are so high that the crop is unable to survive. And those type of unpublicized impacts of climate change, from a temperature perspective, from mortality rates, from heat stroke. So you have to take a more comprehensive approach when you look at adaptation to say, what is the likely impact it can cause to an economy of a country? Yeah. If this is not managed, not only from just flooding perspective, from other aspects of a society. I saw, I think it was a day or so, in New York, where, it was shut down because of heavy snow. Schools were shut down to say, and those are the things that we're talking about. What is that disruptiveness of this climate change, that we are not able to adapt to these changing conditions that will then eventually disrupt society and then impact in terms of economic activity? Because that's at the heart of it, to say economic activity is at risk. And if that then happens, then that means then, global GDP falls and all this time. So for us, when we look at it, then we look at it from that particular perspective to say, there's farmers, that are supposed to provide from an agricultural perspective. There's road network infrastructure, and if you drive, in South Africa and Joburg, summer months, the road starts crumbling.
Yeah.
Because it's just too hot. The tire is not able to survive those type of temperatures. What is then the cost? And what is it that we need to do from a town planning perspective? Because you cannot only deal with that particular risk from an insurance perspective. That means there's another intervention that you need. What is it that we need to have an engagement about in terms of making sure that we can look at our town planning guidelines? We can look at we can work with the South African Engineering Society to say what type of road networks and tar recipes we then need to implement going forward, because we're not going to be able to solve this as scientists talking about how do we fund and how do we insure it. We then need that other aspect of it that deals with more societal measures.
It also comes back to what Nigel was saying about having that quality data and how important it is to collaborate with academia. I know before the KwaZulu-Natal floods of 2022, UKZN published some very interesting research about the likelihood of increased flooding events because of hurricanes going back 6,000 years into the last warm age. And, that's really important to build those linkages between the private sector, academia, and government. Is government listening to this? I know there's a Presidential Climate Commission that kind of is an overarching body that tries to connect various departments of government at a local government level. Or is this a conversation you as a big insurer are having with Selgo, for example?
Yeah, I think the conversation is happening at a government level, and I think South Africa is probably one of the countries that spearhead some of these policy positions. But once it gets to local government, where implementation now needs to really happen, you do have local municipalities. I know City of Joburg does have a climate response strategy, but then it fails because you've got competing priorities at the local government sphere, where you either allocate resources for service delivery or you allocate financial resources to mitigate against climate impact, and that's when the wheels comes off. At that point, they know what to do. They've done the analysis, they've done the work. I know Professor Colin Fuchel from Wits has done extensive work on adaptation with the City of Joburg. Well documented what is it that they need to do. The issue is how then to allocate those resources when you've got issues with Joburg water. And that's where, for me, private sector then needs to come and play, to say yes, and the innovative financing, that we can then bring in with the DFIs at companies like us to say, how then do we make sure that we don't leave that piece of work and intelligence that academia has provided to be able to make sure that we can reduce some of the risk? Because if we don't, it doesn't matter how much investment you're going to do into the water system if you are likely to run out of water. So we're going to put new pipes, and those pipes are going to run dry, because you are not dealing with the other aspect of, managing your dams, making sure that you've got capacity, making sure that people understands what needs to happen in terms of water conservation. So you have to deal with both sides of the coin.
Yeah, but fortunately, we've had now 2 very close shaves, as day 0, one in Cape Town, and also what's happening in Grahamstown as well, that I think is really exercising the mind. We're having these conversations like we've been having on sustainability talks. Just lastly, Nigel, from R&B's perspective, where do you see the big opportunity here to really play that catalytic role and to prove some of these concepts? Is it maybe in some of the rebuilds in response to some of the local event-driven disasters that we've seen, or where do you see the big opportunity?
So I think, the big opportunity is obviously raising awareness, which is what we're trying to do around opportunity for adaptation finance, what it actually means, and which sectors it would be applicable to. I think ideally you would want to try and do it as a preventative measure than a responsive measure, respond to kind of these incidents. Obviously, there's an ability to rebuild in a resilient manner, and I think that's definitely something that we'd be looking at. But I think, there's certain sectors that naturally lend themselves to kind of adaptation finance. So, for example, the agricultural sector, droughts, drought resilient crops. How do you look at that? Yeah, changes in rainfall patterns. How do you look at drip irrigation? Now, these are new or regenerative agriculture. These are new ways of farming that are not traditional, but are probably more future-proofed and probably more resilient to kind of this adaptation, things like that. Or looking at buildings. If you look at green buildings, EDGE-certified green buildings, where you've got temperature variances, extreme heat, extreme cold, which is what we're starting to see. How can you make sure these buildings are resilient through the likes of green building certification or, natural capital? As I mentioned before, how do you invest in natural capital underlying projects that themselves don't generate a cash flow, but we within the private sector and the investor community need to be able to invest in these projects to make sure that they provide the ecosystem services that we much need, removing alien vegetation to make sure that the watersheds produce the water we need in Cape Town to negate ground zero.
Yeah, I think the challenge obviously then becomes, how does one price that? How does one demonstrate the value in a way that's really tangible to the market? But gents, we're going to have to leave it there. Thank you very much, Nigel Beckett, R&B, Abel Sakura, Sanlam. Thank you very much for taking the time out to talk adaptation. I think it's probably going to be one of the big growth areas of conversation in the broader sustainability conversation. And I really appreciated doing the series with you. Nigel, to you and your team as well. Thanks so much. Been a great pleasure. Abel, I'm sure we'll chat in the not too distant future because this adaptation story certainly isn't going anywhere. Well, from me, Michael Avery, we've certainly enjoyed bringing you sustainability talks alongside the team at Business Tech. Until next time, let's keep talking sustainability.